Welcome to Making Retirement Make Sense, the podcast that helps you build a better retirement. Each episode, you'll hear from the industry experts about the issues that matter most to your plan, no matter where you're at on your retirement journey. From pre-retirement to the later years, we've got you covered. Let's make retirement make sense together.
Hello, and welcome to the Making Retirement Make Sense case study series, where we walk you through real financial plans and show you how the experts approach retirement's biggest decisions. I'm your host, CJ Miller, joined today by partner and executive financial planner, Amy Shepard, and also one of my very good friends. Amy, how are you?
I'm great, CJ. Thanks for having me.
You're welcome. I'm so excited for the case you've put together today. We're going to be looking at Roth conversions and just tax-efficient withdrawal strategies in general. I think one of the intriguing parts about today's case is we're actually going to be evaluating a plan where Roth conversions don't make sense. And so even though they are a very popular strategy, it's not right in every case. And so we'll be explaining why that is. And with that, I will turn it over to Amy and maybe explain to us a little bit more about Roth conversions in general before we dive into the details.
Sure. Yeah, so Roth conversions are a really big part of any, retirement income plan. We evaluate them pretty much for, all the clients that I work with. And sometimes the math says, yes, that you should do this. Sometimes the math says, doesn't really look like it's going to be worth it. So the benefit of a potential Roth conversion is you pay tax now and you let the money grow. And later, when you access it in retirement, it comes out tax-free. And so sometimes that makes sense. Sometimes it doesn't. Today, we're going to look at a case where the math says it doesn't really seem to add a ton of value.
Well, Amy, I know you have an Excel pulled up, so maybe we can pull up your screen and start walking through some of these details.
That sounds great. So we're going to walk through a few different versions of a plan today. This first version I'm going to walk through is what we refer to as a base version. It doesn't have any tax management strategies in it. So first thing, before I start to jump into the details, I just want to start by saying when I work with clients, I always start with developing a detailed financial plan. That's already been done. So when we're jumping into this Roth conversion discussion, we've already verified all the details. We've already gone through income and expenses and all of that. And so in this case, we have Wally. He is a single male. He's 67. His income is listed here at the top. His only income source currently is Social Security. And so he started Social Security this year at full retirement age. Next year, he has a full 12 months. The next section of his plan shows all of his expenses and taxes. And then if you combine those first two sections, A and B, we get here to section C, and it takes the numbers from above. And so a very simple math calculation here says income minus expenses equals portfolio withdrawals. And so in yellow, you can see his expected portfolio withdrawals based on his plan. So I'm going to pause there. Any questions so far, CJ?
Yeah, I have a couple. Well, for one, just an observation. You'll notice that on the gap where it shows the yellow, you'll see that they're not the same amount of withdrawals every year. And I think that's really an important distinction for a comprehensive retirement plan. A lot of people will manage it based on a steady withdrawal rate, or even financial software will just show, okay, you're going to take X amount of your portfolio every single year. And in reality, retirement plans that we construct are not often like that because people's spending habits change. And that's a big part of a withdrawal strategy, right?
Yes, huge part. Very great observation. I can't say I have ever created a retirement plan where the withdrawals are the same every year. So just as a side note, some of the things that impact that are, when you start Social Security, the expense estimates that we make. Some years you buy new vehicles, some years you don't. Some years you take more vacation, some years you don't. So all of those personal, real life details have already been baked into this plan.
Excellent. And so you mentioned there's a base case without tax management. Now, obviously, in any scenario, there's going to be taxes in some way. Can you explain, when you say there's a base case, can you explain exactly what that means and I guess what kind of just default tax is in retirement?
Absolutely. So if we go back to the Excel, what I want to show you is all the way down at the bottom here, we have details on withdrawals. And so when I say base case, what I am referring to is, I mentioned before, no tax management strategies, but also it's this idea. Sometimes people think of it as like conventional wisdom. There's this idea out there where people say, all that tax deferred money I have, I shouldn't touch it. I should let it grow tax deferred as long as possible and enjoy lower tax rates. Well, that's what this plan assumes. It assumes a client who has, 1.3 million in traditional pre-tax retirement accounts, about 75,000 in Roth accounts, and then about, almost 600,000 in non-retirement brokerage assets. And so in the base case, we assume that the taxes on those traditional retirement accounts are deferred as long as possible, and the withdrawals are coming from other sources in the meantime. Does that answer your question?
Absolutely. And just looking at the screen right now, I see the big, scary required minimum distribution line. So I'm excited to see how that permeates throughout the different versions of these plans.
Yeah. Well, yeah, let's walk through it. So this version, Wally is going to do what we just said. He's going to defer his traditional retirement accounts, defer taxes as long as possible. So these little minus signs just show no withdrawals. In his first year of the plan, if you remember from above when we looked at income minus expenses, it showed about $91,000 of withdrawals. And that's what you see here. He's going to be taking all of his withdrawals from his non-retirement account basically every year until, if we go out until he is age 73, that is when his required minimum distributions start. So I have highlighted those. What happens here at age 73 is his RMD, required minimum distribution, it's over $66,000. And if you remember, he also has Social Security benefits. Between the RMD and Social Security, it's more money than he is expecting to spend. And so what you see happens down here is there is just under $4,000 that gets deposited into his brokerage account. So in other words, he gets Social Security, he takes his RMD, he spends most of it, but there's a little bit left over that just gets reinvested in his brokerage account. And that same trend happens for many years. He takes his RMD, saves a little bit of it because he doesn't need it for spending. We get out to when he is age 77, and you see here he takes his RMD plus he takes a withdrawal from his non-retirement account. Well, that's because we have a vehicle purchase built into the plan, so he needs a little extra that year. But if we keep going on throughout his plan, that same trend is just happening. He's taking his RMD, he's depositing the extra, all the way until the end of his plan. By the time he's at age 90, his RMD is about, almost $130,000 is the expectation. So that's the logistics. Next, we're going to talk into, what does this mean for taxes? What does this mean for Medicare? Before I jump into that, any questions from you, CJ?
No, I think everybody's following, hopefully.
Hopefully. So now we'll start to look at the tax impacts. So if Wally were to follow this plan, he defers those traditional retirement account withdrawals until RMD age, lives off of his brokerage account. What does his tax situation look like? Well, if we come down here, you see this line, top marginal rate. What this shows is this year and moving forward, he is in a 10% tax bracket for several years. I do want to make a comment that these tax numbers are all inclusive of the recent tax bill that was passed. So the One Big Beautiful Bill, those rules have been factored into this model. So if Wally does that, he is in a 10% tax bracket for the next several years. And then he turns 73. He has to take an RMD. It bumps him up into a 22% tax bracket. And he stays, estimated to be staying in that 22% tax bracket for most of retirement. Eventually, RMDs, they grow as you age. And so when he's in his late 80s, there's the potential that his RMDs get so big it bumps him up into a 24% tax bracket. So that's high level tax story that this plan shows. Any questions there, CJ?
Well, just one observation is it looks like his income's so low that his total tax is zero. Is that something you see often with your clients? And was there anything in the new tax bill that has kind of amplified that?
So his tax bill is zero, potentially. I can't say I see it all the time, but frequently there are situations where it does happen. It definitely, in a situation like this where the only income source is Social Security, and then the withdrawals are potentially coming from a brokerage account where there's the ability to realize capital gains at a 0% tax rate. Yes, it does. It is doable. Sometimes people are shocked to see it, especially for somebody with, over $1 million in retirement savings, but we do see it.
Absolutely. The other question I have has to do with the difference between a marginal tax rate and an effective tax rate. And I see marginal rates used as kind of a guidepost for a lot of people. We definitely use them. It's a good way to illustrate kind of what the next potential tax could be, in certain situations, and to identify kind of big jumps in income. But really, when we look to manage taxes over time, it's really the effective rate that we want to balance, over the course of a 30-plus year retirement plan. Can you explain to us a little bit about the difference between a marginal rate and an effective tax rate?
Yeah, of course. So the marginal rate is the top tax bracket you fall in. If you're in a 22% tax bracket, what that means is some of your income was taxed at 10%, some was taxed at 12%, and the very last dollars that were taxed at that higher 22%. Not all of your money was taxed at 22%. Marginal rate is progressive. It goes up. So you're taxed higher the more you earn or the more money you have. Effective rate is more like an average. It's if you take all the tax you've paid and compare it to all the income you have, what percentage of tax did you pay on all of the income that was reported? So that's the difference. And we can actually look at that in the spreadsheet. So it shows what I walked you through, which is what top marginal rate is this client falling in. But then we can also see below it, there is a line that shows the effective rate. And if I go all the way back to the beginning, you can see, so let me see, I'm going to try to highlight that here, but this shows the effective rate. And for many years, it's zero. There's no tax being paid. As RMDs happen, the effective rate does go up. But to your point, 22% is the marginal rate. Not all dollars are taxed at 22%. The effective rate is the overall tax rate this client pays, which in this case is, about 15.5%.
Absolutely. One of the things I like about using effective tax rate as well is it kind of bakes in all of the irregularities, is what I'd call them, in the U.S. tax code. The things that don't really seem to make sense or are hard to incorporate in just general napkin math. So one example is the Social Security income. This particular client, this sample case study, has Social Security income kind of day one. And you'll see right under the effective rate on that spreadsheet that there's a line that's percent of Social Security taxed. And so, in the very early years, in the low income years, it looks like that is under the maximum of 85%. Can you walk us through how that particular portion of the tax bill works?
So the way it works, sometimes people are surprised to find out that their Social Security is taxed, but the kind of a simple way I'll try to explain that is if your only income source is Social Security, there's no tax on it. As you start to have more income sources, then a higher percentage of your Social Security benefits are taxed. It's basically means testing it. If you have means outside of Social Security, then there's the potential you're going to pay more tax on your Social Security benefits. If Social Security is your only income source, there's no tax due. And so it's a way for higher income earners, people who have more wealth, to pay more tax on Social Security benefits than somebody who otherwise wouldn't.
So in other words, as far as the case study goes, just because you're in the top 10% marginal rate doesn't mean that accelerating your income, you'll only pay 10%. Because it can impact some of those other factors.
It can, yes. And we definitely see that when we're doing tax analysis. Sometimes we'll say, you're in a low tax bracket year, and then we do a Roth conversion. Then we say, not only do you have to pay income tax on the Roth conversion, but now more of your Social Security is taxed. And so there's a compound effect there.
Yeah, it's one of the most common confusions about the program. And Social Security to this day, you don't get a tax deduction. And so that's why they have to give you 15% back. Otherwise, it's pretty much complete double taxation.
Yep. So yes, this client potentially in this scenario, they get to enjoy some years of zero tax on their Social Security benefits until RMDs start. So just as a quick recap, this is a client who's delaying their traditional retirement accounts. They're in, a low, pretty much no tax bracket for early years. And we looked at what the expected tax pattern could be for them. The other thing we always look at is Medicare. So Medicare is, health insurance that's available for those age 65 and older. And it is impacted by your tax return. And so if we come down and we look at Medicare premiums for this client, Medicare works similar to tax brackets in the sense that the higher income you have, the higher your Medicare premiums are. Just like the higher income you have, the higher tax bracket you fall into. And so what I want to point out for this client is line 336. It shows how much room is left in the lowest Medicare bracket. So in 2025, if this is the tax plan the client follows, they have Social Security income, they realize a little bit of capital gains and no other income sources. They have $74,000 of room on their tax return before they're going to trigger higher Medicare premiums. If we follow the plan out throughout this client's lifetime, you see there's room in all these years until RMDs start. Well, the year after RMDs start, you see red and you see the word over. What that is saying is between Social Security and the RMD, this client's income is now over that first Medicare threshold, and they will have to pay something called IRMA. CJ, do you want to share what IRMA stands for?
Sure. It's income-related monthly adjustment amount. Definitely a government moniker having so many words in one phrasing there. Now, looking at the tags on the Excel sheet, the kind of the increments there, this is a very common question we get from clients when we're actually walking them through there. So just to clarify for the audience, the $87.70 per month, that is the amount of the increase over the base premium. And so like increase 2 is $220 per month over the base, right? And so it's always basically saying, what is the total amount you're paying more compared to what you'd be paying at the base level?
Yes.
So it's not incremental jump to jump, but I know we have some diligent audience members that will be looking at those numbers and going, where do those come from?
Yeah.
Because they don't match the actual premium amounts.
Yeah.
But you see it escalates pretty quickly. I mean, at the top level, you're talking about, $530 per month per person.
Yep.
That's $6,000 or more a year.
It's a lot. Yeah. And so for this client, by, deferring the tax on their traditional retirement accounts, it has the potential to cause higher Medicare premiums around RMD age. And then if we go later in life, for most of this expected plan, they have to pay, a little bit higher Medicare premiums. They're only in the first tier. But eventually, as those RMDs grow, you see it goes up another tier. So it's not a significant amount of IRMA, but it's there. And so those are some of the things that we look at. And then we say, well, can we make this plan more efficient? Like going back to that base scenario, that idea of, let's defer taxes, let's defer those traditional retirement accounts as long as possible. Is that the right thing to do? So we use metrics to help us answer that question. One of the metrics we use is something called fundedness. I'm going to find that section here. So this number right here is a fundedness ratio of 174%. Well, what does that mean? Going back to the client's plan, if we look at all the withdrawals that they're expected to take throughout their lifetime, that's this line here in yellow, all of those withdrawals, to accomplish that, they would need to have about $1.1 million today. If they had $1.1 million, they would have 100% of what they need, but they have more. So this client, they need $1.1 million. They have over $2 million, which means they have 174% of what they need. They are overfunded, which is a good thing. It means there's cushion in their plan. So we also think of this fundedness ratio as a lifetime withdrawal rate. Do you have enough money today to fund all of your future withdrawals? The answer for this client appears to be yes. Any questions there, CJ?
not questions, but I think the audience might be a little confused about the different discount rates on that spreadsheet. And I think this is really important to clarify because the reality is any financial plan, there's one underlying principle that everybody should know when you're evaluating really anything financial in life, which is that $1 today is worth more than $1 tomorrow. Period. And so that's why it's important to look at present value and not just future value dollars, right? You might save on taxes today and pay less over your lifetime, but if you're basically paying more tax today and saving on taxes 20 years from now, well, those dollars 20 years from now are not worth as much.
Right.
And so what I like about this fundedness metric is when you look at it, it basically will apply different discount rates. So when Amy said, if you have 1.16 million, you can meet your future withdrawal needs, the way to factor in the discount rate is to say, that's if you earn 4% on your money. Yeah. If that 1.16 averages 4% per year for the life of the plan. If you earn 5%, you'll see they need less. If they need 6%, you'll see they need even less. And I think that's just an important distinction to make that, sometimes there's underlying assumptions about market returns or how you invest your money might determine, the output of some of these figures outside of just the tax numbers.
Yeah. Great point. Thank you so much for covering that. So that's one of the metrics. Something else we look at, to CJ's point, it's another present value calculation, but we also look at, what is the lifetime amount of taxes paid in this plan? It's about $308,000. Another thing we look at is what's the lifetime amount of medical expenses. So it's $212,000. That medical expense category, it includes Medicare premium. So, theoretically, this would be higher if you have IRMA applied, and it would be lower if you don't. But it includes both Medicare premiums and out-of-pocket medical costs and premiums that we have built into the plan.
And these are all in present value dollars, Amy?
These are all in present value dollars. That is correct. So you would need $212,000 today in 2025 to cover all future medical expenses in the plan. So that's a lot of detail, but we're going to look at two more versions of this. Okay, so the second version I am going to show has all of the same initial information. It has the same income numbers. It has the same expenses. What is going to look a little different on the expense side is taxes, and we're going to get to why. But same concept here. You take income minus expenses, and you get to this withdrawal number, which also looks different. Well, why? What we did in this version is we said, well, what if Wally doesn't want to follow conventional wisdom? What if he wants to take IRA withdrawals during those years before his RMDs start? And so that's what we tested here. If we come back down to the withdrawal section, what you'll see is instead of having all of his needed withdrawals come from his non-retirement account, we now have some coming from his traditional retirement account, that's his IRA, and then we have some coming from his brokerage account. Well, one of the questions that I sometimes get asked here is, well, why $40,000? What determined that amount? Well, in this case, what we're trying to do is we're trying to fill up lower tax bracket. So in his case, we're trying to fill up the 12% tax bracket. We're also trying to fill up the lowest Medicare bracket. So we're being strategic in the withdrawal amount, being conscious of both marginal tax rates and, Medicare tax brackets. Before I go any further, any comments or questions from you so far, CJ?
No, just one observation is by, accelerating the income, you can see that things like Social Security, right, are now going to be taxed at more.
Yep.
And so one of the benefits of taking a broad view is to really be able to compare, okay, yeah, even though you're going to pay more on Social Security tax or sometimes pay more in Medicare earlier on by doing these strategies, they can still make sense.
Yes, sometimes they can. Sometimes they make a lot of sense, and sometimes we're going to see in this case, the numbers don't really change too much. So with this client, some important things to know is, this is what we're illustrating, that rather than just delaying their traditional retirement accounts, they are filling up the 12% and or lowest Medicare bracket. They do that for several years by taking IRA withdrawals. And then when they get to RMD age, their RMDs are a little bit less. They're under 60,000 here. So basically, between Social Security and RMDs, instead of having more money than they need, now their RMDs aren't as big, so they have to take a small amount continued from their brokerage account to cover all of their expenses. how does this impact the tax and the Medicare numbers? That's what we really want to focus on. Well, if we come back down, what we see is this client is in a 12% tax bracket now for several years. Still, when RMDs start, the tax bracket does jump up to 22%. But now, potentially, depending on how the market performs, potentially this client now can stay in a 22% bracket. There's no jump up to 24 because the future RMDs are less because we took money out of the IRA earlier on in the plan. The other question is, how would this impact Medicare? So if we go down to that same section, what we have is this line here. So like before, there's room in that lowest Medicare bracket. If you remember from the first video, I think it was like $74,000 of room. In this version, there's less room. There's $27,000, but you're still in the lowest Medicare bracket. And then as we go out through the life of the plan, how does it change? So now, instead of triggering IRMA at age 74, we get to enjoy potentially 2 extra years at lowest Medicare premium. So IRMA still happens. It's just maybe a couple years later. And then when we go out to the end of the plan, it's the single one level of IRMA throughout the plan, instead of potentially having the second level of IRMA later on. So any questions on those points, CJ?
Nope.
Okay. And so back to, what does all of this mean? How can we evaluate it? Well, let's look at those metrics we talked about before. So the first one is that fundedness ratio. Is there enough assets to fund all the future withdrawals? When we looked at it before, it was 174. When we look at it this time, it's still 174. So by taking those extra IRA withdrawals early, no real impact. What about lifetime taxes and lifetime medical costs? So taxes in the first version were $308,000. In this version, they're about $305,000. Not materially different. Medical expenses before were $212,000. Now they're $208,000. So not they're less, but it's not like a mind-blowing amount. It doesn't dramatically impact the plan. So something else we look at is, what about Roth conversions? Like, since this client has these low tax years the next few years before RMD start, do Roth conversions make sense? Well, I will start by saying we try to think through any type of decision in 2 lenses. We try to think of the math and then your emotions. How do you feel about it? In this case, I'm going to start with how the client feels about it. This is a client who is single, so they don't have a spouse to think of future tax rates after they're gone. We also talked about legacy goals. Does this client have any desire to leave more tax efficient assets to their heirs? In this case, the answer was no. And so we said, well, let's see. Can Roth conversions help save you taxes over your lifetime? Can Roth conversions help save you money on Medicare premiums over your lifetime? We're really trying to see in this case if Roth conversions can add value for the client, because we're not trying to really add value for the next generation in this case. Any questions there, CJ, before we look at the Roth conversion version? Roth conversion version. That's fine.
No questions, but I am really intrigued to see how this analysis goes. And I love the way you framed that, of basically not just focusing on the quantitative, but also the qualitative.
Yeah.
And I think one of the challenges that people have with these decisions is they want the numbers to kind of add up and point a clear path. But the reality is retirement planning is about balancing these considerations. And something that I've seen just practicing with clients over time is that there are many occasions where if you are a single filer, Roth conversions don't actually make sense. One of the biggest benefits to a spousal couple is that you have married tax rates for an indefinite period of time. Most of the time you're going to have a sole survivor. And the longer you have a sole survivor, right, the harder it is if you're not accelerating income and taking advantage of the married rates. Well, a single filer doesn't really have, that issue. So I'm really glad that you brought that up.
Yeah, it's such an important part of any financial planning is, yes, there's the math, and we want to make sure the math works. But, at the end of the day, what's important to the client is going to take priority over the math. The math is one piece of the puzzle, but somebody's individual values is often a much bigger piece of the puzzle.
Well, let's look at the Roth conversion case and see how that worked out for this client.
Yep. So in this case, it's the withdrawal strategy is gonna be similar to what we looked at in the last version. So in the last version, we talked about, well, hey, let's take enough withdrawals to fill up that lowest Medicare bracket or 12% tax bracket. In this case, instead of doing withdrawals, we say, hey, well, let's just convert that amount over to the Roth. We'll pay the taxes up front, and then we'll have more money in the Roth account to grow for future use. Well, one thing I want to point out here is for this client, if you remember, in the first version, that base version, no tax managed strategies, it said that the client needed about $91,000 of withdrawals to cover their expenses. In this version, if we do the Roth conversion, they now need $101,000 of withdrawals. Well, their expenses, everything is the same. The only thing that's different is now they're paying more tax because they are taxed on $40,000 of IRA income. And so now they need $91,000 to cover their expenses, and they need an extra $10,000 to cover taxes. So that's the situation here is we do Roth conversions. They're small ones, but potentially we do those all the years until RMDs start. And so in this case, go ahead, CJ.
Sorry to cut you off. I just wanted to make one, but really a question, but it really could get even worse than that on the non-retirement account side if you're in a position where maybe you have a lot of capital gains embedded in that non-retirement account because now you need more liquidity, you need more cash flow. And so we've seen cases where not only does your withdrawal go up to $101,000, but also you're in a position where now you need to realize even more tax through the sale of capital gains, which there's a market element to whether or not that makes sense too.
Yeah.
You don't want to let the tax tail wag the dog, but it is definitely an extra consideration.
It is, and it can really complicate how you decide on the amounts because there's multiple tax layers to consider, not just what marginal tax rate do you fall in or what Medicare bracket do you fall in. Could never be that straightforward. That would be too easy.
Absolutely.
Yeah. So in this case, if the client were to do the Roth conversions, if we look at the tax strategy, the lifetime expected tax rates, they don't look dramatically different. It still shows 12% the next few years. And that 12% is because of Roth conversions. They're not taking withdrawals. The tax doesn't change from the last version. It's just money's getting converted in this case rather than withdrawn. And, they stay in a 22% tax bracket potentially throughout retirement. Medicare looks a little bit better. So again, if we're talking about Irma, I feel like so many people have a great Aunt Irma. I always think of it as a person, but it is extra Medicare premiums. So if we look back here,
if it was a person, it wouldn't be a person that you like.
I don't think it would be a friendly Aunt Irma.
It'd be like an annoying neighbor.
Yes. So in this case, with the Roth conversions, you see that by doing the Roth conversions, Irma doesn't apply until, in this example, potentially age 80. So the Roth conversions provide a few more years of lower Medicare premiums, but it's not significant. And we'll see that, if we go all the way out to the end, this person just stays in that first Irma tier. But when we go back to the metrics, what we'll see is that doing those Roth conversions, taking advantage of those, potential low tax brackets early on, what does it do to that fundedness metric? Well, if you remember, it was 174 before. Here it's 173. It's almost identical, but it's a little less. And the reason it's a little less is because now this client is proactively paying more taxes early on. They're not saving a significant amount of tax later. And so it really doesn't add much upfront value. Any comments or questions there, CJ?
No, it all makes sense. And I think one of the ways that we like to frame these decisions is in red, yellow, and green. And you think about it like a stoplight. And so, in a lot of cases, a Roth conversion strategy, when we run this analysis, is green. And we definitely advocate, yes, pay the additional tax now. It is worth it. This seems more like a yellow case in the sense that it's not red either. It's not saying definitely don't do it. Amy, I'm curious your thoughts on, in this particular case, what factors would you look at when you're kind of in that yellow? You could do it, you could not. How do you approach that analysis and how would you pitch that to this client?
Yeah, that's a great question. And so we talked about it. I said there are some benefits here. One of the potential future benefits that we can't really capture in a point in time analysis like what I just walked you through is, well, in this plan, we're using conservative estimates that the portfolio averages 5%. Well, what happens if the next 25 years for this client, their portfolio averages 8% or higher than what we planned for? Well, that means there's a compound effect. Their future RMDs are bigger. Their potential IRMA is bigger. And so I asked the client, like, are you going to be okay with that? What happens if your portfolio performs better than we expected and now you do have to pay more tax later on? This client said, that's fine, right? I should have the money to do that. And I said, you should. Also, there's future strategies that can be employed. If you get to age 70 and a half or RMD age, depending when that is, and if your RMDs are bigger than you initially thought, there's something called qualified charitable distributions that you can do to help minimize that RMD, minimize the tax and the IRMA impacts. And so when I talked about it with the client, I said, you're not locking yourself in today. You're making a decision today based on what you think is best. And we revisit that decision as time goes on. I also asked the client how they felt about having more Roth money for their heirs. And they said that wasn't really a priority in this case. They felt good knowing that once they were gone, their family was going to inherit money, but they didn't feel the need to prepay tax, especially if it didn't really change things for them.
That makes perfect sense. And ultimately, that came down to a values-based decision, like you said at the beginning. And I think what's really interesting about any financial planning is that, like you said, it's a point-in-time analysis, but it requires a flexible framework.
Yeah.
I love this spreadsheet. I live and breathe in this thing.
Yeah.
It's one of my favorite things about what we do. And everybody that knows me knows that I'm a big Excel aficionado. However, there are some limitations. And I think one of the limitations is just that we don't have a crystal ball. And so, we're even seeing this right now with when we redo the plan from last year to this year with the new tax rates.
Yeah.
And now we're going from, an environment where tax rates were scheduled to go up, and now they're not. And technically, the bills, the OBBA made the tax rates permanent. But we always have to explain there's no such thing as a permanent tax rate. There's going to be other administrations, other congressional makeups that will potentially change tax rates in the future. And we don't know whether that'll be up or down. If you look at historical tax rates or you pull economists, most people think it's more likely that they're going to go up over the next 30 years than down.
Yeah.
But because we don't have that crystal ball, we don't really account for that in this spreadsheet.
Yeah.
It's impossible to.
It is. We do have the crystal ball right here, but so far it hasn't provided us with any correct answers. So, that is really the gist of how we evaluate Roth conversions. As a recap, we want to look at the math. We want to see what the math says. We also want to factor in the client's goals and values. And in this case, for this year in particular, we decided a Roth conversion doesn't make sense. We're going to look at it again next year and the year after that. And there may be a point where it changes and we decide to do some, but at the onset, it didn't look like it was going to add a significant amount of tax efficiency to the plan.
Great. Well, thank you so much for walking that through that with us, Amy. We really appreciate it. And so thanks everybody for tuning in to a Making Retirement Make Sense case study.
We hope you enjoyed this episode of Making Retirement Make Sense. If you found it helpful, please like, subscribe, comment, and share it with someone who you feel could benefit from what we discussed today. And if you're feeling extra generous, we'd welcome a review on Apple Podcasts or Spotify.